Your mortgage has jumped $350 a month. Your house is worth $40,000 less than what you paid. Your energy bills have doubled and there's no help coming. If you bought a home between 2020 and 2022, then this video is for you. Because what's happening to you right now might not be bad luck. It could be by design. It started with what looked like the deal of a lifetime. The government axed stamp duty. Interest rates were at basically zero. Suddenly, every mortgage advisor, estate agent, and property expert was saying the same thing. Buy now, because you won't get another chance like this. It felt like a free pass. No stamp duty meant you could stretch further. Go for that house that was just out of reach. And when the bank said you could borrow $400,000, most people took every penny. Because it felt like the system was finally working in your favor. Think about the psychology of it. You're saving $15,000 on stamp duty, rates are at rock bottom, and the house prices are climbing every month. So when that house came up that was well over your max budget, you went for it anyway. Because the savings on stamp duty covered the difference. Right? But here's what many didn't consider at the time. Those attractive low rates were fixed-term deals. 2 years, 3 years, maybe even 5 if you were lucky. And now, those deals are ending. Take a family with an average household income of $3,400 a month. If they borrowed $280,000 at 2.1% in 2021, their monthly payment was around £1,200, just over a third of their monthly take-home. Well within affordability. Add another $700 for utilities, council tax, transport, another $500 for food and household spending, and they'd still had roughly $400 left over each month. Not for luxuries, but just a little buffer for an MOT, a school trip, maybe even save for a family holiday. Fast forward to 2025, the new rate is 4.68%, and their payment jumps from $1,200 to $1,550, an extra $350 a month. But what makes this a crisis is that it's not happening in isolation. While they settled into their new home, everything else was quietly getting more expensive. The energy bill is up from $120 to $200 plus a month. The weekly shop that costs $100 now costs $120. Fuel, council tax, insurance, all quietly rising. They're spending an extra £300 to £400 a month just to maintain the same lifestyle they had 3 years ago. Their monthly costs have risen by £800 minimum. And let's be honest, most families don't live in a spreadsheet. Their kids that were toddlers in 2021, they're now in school with uniform, clubs, packed lunches, and new shoes every 6 months. Or maybe they've had another child since buying because they planned a future, not for a crisis. Meanwhile, inflation has eroded the value of every pound they earn. So that £400 buffer is gone, replaced with a shortfall. And the longer this goes on, the deeper that hole becomes. In 2021, my cousin bought a new home. He offered $30,000 over asking just to get accepted. Many people did. Maybe even you. Because back then, there was no negotiating. Buyers were panicking and overpaying just for something decent. But the truth is, most people stretched way beyond their budget. What looked like a bargain was actually a premium. And now, Rightmove just confirmed what you probably suspected. Asking prices are falling. The biggest July house price drop in 2 decades. That $450K house you just bought is struggling to get offers of $420. That £30,000 you'd made on paper is gone. And just to make things worse, unemployment is now at its highest level since the pandemic. And if you're lucky enough to still have work, wage rises aren't keeping pace with inflation. So you're trapped, property trapped. You can't sell without taking a massive loss, can't afford the new mortgage payments, can't refinance your way out because the whole market has shifted against you. So what happens next? Well, it's already begun. Mortgage possession claims in England and Wales rose 31% in 2025 year on year, but the sharpest cliff edge is Q3 2025 to Q4 2026. The Bank of England is warning, if interest rates stay above 4%, millions will see their mortgage costs spike, and thousands could be stressed financially by late 2026. So that's the regulator telling you that the pressure's only just started. This was never a housing market crash. It was a debt time shift. Prices didn't collapse. People didn't default overnight. They signed fixed rate deals that delayed the pain for 2, 3, 5 years down the line. It looked affordable until the fix expired. And every one of those mortgages was like a slow detonation. A few years of peace, then boom. You weren't reckless, you weren't greedy. You were told, buy now, lock in your rate, don't miss your chance. The government removed friction and called it affordability. Brokers, agents, sellers, even the Treasury, everyone got paid. Now the fix has expired and you're the only one still paying for it. If your fixed rate ends within the next 12 months and you're worried, speak to your lender. Most would be happy to agree a new rate within 3 to 6 months of your end date. And doing it early could mean avoiding the worst of what's coming. Ask about a temporary switch to interest only. It's not ideal long term, but it gives you some breathing space for 6 to 12 months and is better than switching to the SVR because the standard variable rate is brutal. Clean your credit report before you're judged by it. If you're late on a utility bill or missed a Klarna payment or maxed out a credit card, try and fix it. You're not broken, you're not a failure. You played by the rules and the rules changed mid-game. They call it ownership, but for 1.6 million families, it could just be a countdown. When debt becomes destiny, the question isn't how you bought, it's who sold it to you and why. The mortgage time bomb isn't ticking, it's already here. You might not hear it, but the system does, and it's getting ready to collect.